In today's video, I'm going to show you 3 ways that you can strategically fund your Roth IRA, and make sure you stay to the end because I'm going to explain what a backdoor Roth conversion is. And if you're thinking about retiring here soon, we have a quiz that you can take after this video called the How Much Do I Need to Retire quiz, and it'll ask you a few short questions that'll hopefully get you some answers on how you're set up for long term when it comes to retirement. If you're new to the channel, my name is Ryan and I'm an advisor here at Carlson Financial, and we help those of you that are either near retirement or already in retirement. And today I want to talk about funding a Roth IRA. So just a quick refresher on what exactly a Roth IRA is. A Roth IRA is a retirement account where the funds inside of it have already been taxed. So you didn't get the tax break up front like you would with a traditional IRA or the 401k where you can deduct your contributions, but instead you put it in post-tax into this Roth IRA, and now the money that's in there is going to be growing tax-free for the rest of your life. And when you pull that money out and use it as income, it's going to be coming out tax-free. So Roth IRAs are some of the best retirement vehicles out there. Okay, so option number 1 is by far the simplest option. It is simply moving money from your bank account, like your checking or your savings, and just taking the contribution to the Roth IRA from that checking over to your Roth IRA. So let's assume you had $10,000 in your checking account and you wanted to contribute to your Roth for that year. In 2023, if you are over 50 years old, you can contribute up to $7,500 this year. So you could just take $7,500 from the checking and move it over to that Roth IRA, and that's it. Easy as that. But okay, let's assume that you have that $10,000 in your checking and savings because you like to keep it as an emergency fund, and you don't feel like lowering that emergency fund down to less than $3,000. So now we've got to look at other options for you. So let's get into option 2. So option 2, we're going to assume that you've got the $10,000 in savings, like I said. You've also got a taxable brokerage account that has $100,000 in it right here. You've got a 401k over there that's $800,000, and then down below is obviously your Roth and a traditional IRA. And we'll talk more about that traditional IRA that's down there here in a bit. So option 2 would simply be, instead of taking money from the checking and savings like option 1, we would take money from this taxable brokerage account and move it to the Roth to make our contribution. Now the difference by doing it this way compared to option 1 is that the earnings in that taxable brokerage account, the earnings, the dividends, those are taxable. So let's say that you had stock in that taxable brokerage account that has grown over time. When you sell that stock to contribute it, move it to the Roth IRA, you may have some capital gains that will affect your taxes that year. For this example, we're going to assume there's no major tax implications of moving. So, like I said, you just moved the $7,500 from the brokerage over to the Roth, which gives you your $7,500 there, and now your taxable brokerage has $92,500 in it. So that's option number 2, taking the money from the taxable brokerage account and putting it in the Roth IRA. That brings me to option number 3. So what happens if you maybe make too much money to contribute to a Roth IRA? So in 2023, for a single filer, if you make more than $153,000, you cannot contribute to a Roth IRA. And if you're married and you make $228,000 or more, you also cannot contribute to a Roth IRA. So that brings me to the backdoor Roth, which is essentially just an awesome loophole that you can use to still get money into a Roth, even if you make too much money to contribute that year. So here's how it would work. Instead of contributing to the Roth like we did in option 1 and option 2, what you're going to do instead is you're going to contribute to a traditional IRA, but the key here is it's not going to be deductible, right? You don't get that tax break when you put the money in the traditional IRA like you normally would. So now you have a non-deductible traditional IRA included in your batch here. So you've got the checking and savings, the taxable brokerage, the same thing, but that traditional IRA, we still are going to pretend we don't know what's in there yet because it'll help us determine how much of the backdoor Roth conversion is going to be taxable. So the equation they use to determine how much of your conversion is going to be taxable is this one right here. It's taxable amount equals total pre-tax dollars in all of your traditional IRAs divided by total dollars in all traditional IRA accounts, right? And then you're gonna multiply that by the amount you are converting that year. Example one, let's just assume that you have that non-deductible traditional IRA, like I mentioned, it's got the $7,500 that you plan to convert, and then you don't have a traditional IRA sitting out there. You have $0 in a pre-tax traditional IRA. So in this scenario, when you do that backdoor Roth and you convert that $7,500 over to the Roth IRA, $0 of that is going to be taxable, which is great. But it's probably unlikely that you just have $0 in traditional IRA. A lot of times I see people have had, old jobs or old 401ks that rolled into traditional IRAs sitting out there, and there's usually a little bit of a balance out there floating that's going to affect this backdoor Roth conversion. So now let's pretend that, like I said, you have an old job where you maybe rolled over a 401k into a traditional IRA, and you have that sitting there with $7,500 in a pre-tax IRA, and you also have that non-deductible IRA that you put $7,500 in this year to do your conversion. All right, so let's solve for this. So we know that $7,500 is in the pre-tax, and we know that we've got to divide that by the total of all IRAs, which we know we have $7,500 in the non-deductible and the $7,500 in the pre-tax, so that gets us $15,000 in all. We are timesing that by what we're converting, which is the $7,500 in the non-deductible, and after you run that math, what you're going to get is your taxable amount for your backdoor Roth conversion in that year. So I know tax season may feel like it's pretty far away, but we all know it's going to get here extremely fast. 2023 is flying by. So I hope this video helped. If you're wanting to contribute to a Roth IRA this year, I want to make sure you have a plan. It doesn't mean you got to do it today or tomorrow, but you need to have a plan for how you plan to get your contribution from wherever you're getting it from into that Roth IRA. So I hope this helped. Again, a reminder, go down below and take that "How much do I need to retire" quiz. I think it's something that'll get you some really valuable results to give you an idea of how your retirement is looking. Please subscribe to the channel, like this video. If you like videos like this, I'm going to be releasing new ones each week, and I would love for you to get those sent to you right when I do. So thank you so much for watching, and we'll see you again next week.